Recession protection. Mr. Market, pay me to wait. The best mob movie of all time, in my opinion, is Goodfellas. Look, the movie's not for everyone. There's a lot of swearing and horrible, gruesome killing. And it's rated R, so don't watch it with your kids. But Robert De Niro, Joe Pesci, and Ray Liotta are great in the movie. Here's the Goodfellas business mindset that sums up the movie.
Business bad? You pay me. Oh, you had a fire? You pay me. Place got hit by lightning, huh? You pay me.
I believe there's a substantial chance that this is a long, drawn-out recession. And in between superstar opportunities, I want to get paid to wait. Mr. Market, pay me to prepare and profit. In the United States, there have been 2 quarters in a row of negative GDP growth. Commodity prices have softened, which can temporarily ease cost inflation. However, interest rate shocks take longer to work through the economy. It seems highly likely that we will see minimal economic growth over the coming quarters. A recession can be crippling to the unprepared investor. If you have no cash to deploy near the bottom of the market, it will be very difficult to ride the future waves higher. Building on the narrative in the last and this month's edition of the KRO, incredible opportunities are possible for those who are prepared. Resource stocks are incredibly cyclical, and most are highly sensitive to economic conditions. Thus, in a recession, resource stocks can fall to incredibly low valuations. But on the upswing, they can rise tremendously. The KRO has taken Katusa free rides on as many of its holdings as we have had the opportunity to do so on. Notes for novices. A Katusa free ride, click the link here to find out more, reduces your risk and returns your principal and allows you to capture any future upside at no risk, meaning you get your money all back. We've maintained the position for years to have and build a cash position to deploy when markets fall. Portfolio Preparation 101. I've long stated that 2/3 of a resource portfolio should be in investments. Those are businesses with significant cash flows and the ability to pay a dividend from free cash flow. Expanding on this, we want diversified cash flows. This means that income earned by the company should be derived from multiple mines and from multiple commodities. Simply put, diversification lowers but does not eliminate risk. Everything in resources is risky. Picking up cornerstone investments in market troughs, that's when it's low, is crucial to preserving and generating wealth from resource investments. Recessions give investors the once-in-a-decade type of opportunity to buy multiple tranches of world-class companies at massive discounts to traditional valuations. For example, in the depths of the global financial crisis, Teck Resources, which is Canada's largest diversified miner, traded below $4 per share. On a price-to-cash flow multiple basis, this represented 0.5 times annual cash flow. Prior to the global financial crisis, Teck was trading at $50 a share and 7 times annual cash flow. Moving forward a few years, Teck rocketed to new highs above $60 a share and over 8 times annual cash flow. That's the chart you're looking at right now. Newmont, one of the world's largest gold miners, showed a similar pattern. Prior to the crisis, Newmont shares were selling for $50 to $55 per share, valuing the company at 10 to 12 times annual cash flow. In the financial crisis, shares fell to about $20 a share, compressing the valuation to less than 5 times annual cash flow. By 2010, Newmont was back north of $60 a share, as you can see in the chart here. We're not trying to feed confirmation bias and pick your favorites. We're letting the numbers and data do the talking and seeing where the chips lie at the end. Now, let's review the blueprint. World-class resource companies checklist. Diversified asset base across multiple commodities. Assets are in multiple jurisdictions with emphasis on positive swap line nations. Dividend payer and ability to unlock shareholder value in creative ways. Ability to generate over $1 billion in free cash flow from current assets or fully funded organic development projects. Survived the previous market downturns or demonstrated longevity within the resource sector. And absolutely key is a low debt relative to the company size and cash flow generation. Debt is death. First, let's break down the companies in the world by commodity. Each color represents the specific commodity's contribution to a company's total revenue. Look, there's a lot going on in this table, but it gives you kind of the depth of what we do. At the top of the chart, you will see gold-focused producers like Newmont, Barrick, and so on. In the middle, base metal producers like Teck, Freeport, followed by the diversified miners like BHP, Rio Tinto. Mr. Market, pay me for patience, free cash flow analysis. One major way to recession-proof your portfolio and pass the time is that in a recession, we want to be paid to wait. It's the same thesis we used when we bought Brookfield Renewables and Pembina Pipelines in the March 2020 correction for myself and subscribers at the same time at the same price, which led to dividend payments and solid gains of 31% and 52% respectively in less than 6 months. And yes, both became Katusa free rides. Myself and subscribers continue to hold free shares at no cost base and collect dividends in world-class companies with no capital at risk because both are Katusa free rides. To be paid to wait, companies must generate free cash flow. This means cash inflows from mining activities must be greater than the capital required to operate them and to develop new projects. The next chart you're looking at, which shows the cumulative free cash flows of each company since 2009. Look at that. Doubt you've seen that anywhere else. As you can see, BHP stands head and shoulders above the rest. That doesn't mean you should go and buy BHP today. There's more to buying stock than just a few analytical comparison charts. Now let's do an apples to apples comparison and look at free cash flow yield. Free cash flow yield compares the free cash flow generated by a company to its market cap. The higher the free cash flow yield, the better. So here's the formula for it. The free cash flow yield is annual free cash flow divided by the company's market cap. And I'll do the homework for you all. Here's a chart that shows the free cash flow yield over the last 12 months, TTM, trailing 12 months, and what's estimated using the 2022 best estimate rates. That's in the black. These types of apple-to-apple comparisons allow us to see discounts on a relative basis. For example, Vale, the big Brazilian iron ore producer, trades at a very high free cash flow yield, which we know is due to its Brazilian risk factor. On the other hand, look at a company like Franco-Nevada, which is the precious metal royalty and gold streamer. It trades at a very low free cash flow yield relative to the rest of the group. This shows that the market assigns a very high premium to Pierre Lassonde's Franco-Nevada. Crippled corporate cash. High debt levels can cripple a company or even bankrupt it, and this becomes even more challenging as interest rates rise. Higher interest rates mean any new debt issued is likely going to be at a higher cost than any debt issued in the past 5 years. We take this analysis a few steps further and do all the heavy lifting, so you don't have to. All the major mining companies were put through stress tests in the ring of fire in the Katusa's resource opportunities. Before you buy any resource stocks, find out who will barely survive a recession and who will thrive. And get to know the companies that I'm buying personally and which ones are on my radar. That's how you invest like an alligator. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.